Well, thank you for coming out tonight. We're going to get started. My name is Zach Call. I'm the president at Capita Financial Network, and I like to give you a little bit of an update each time because it feels like every quarter we've been growing so much. I think it's been fun for people to at least hear that. And Laura, I think will you check with Laura? There might have been a microphone for someone with hearing issues. Will you check on that just to make sure we get that on everybody? Okay, so Capita has 18 financial advisors now. We have 52 total employees. When I started, we had about 300 households that we helped and about $90 million in assets that we managed, and there were 5 of us. And we now have almost $2 billion in assets, 2,500 households that we do retirement planning for, 18, like I said, 18 advisors and 52 employees. So it's just been this massive growth. And last week we moved into a new space, which we're so excited about because people were on top of each other. You know, we had people in the background of Zoom meetings making sandwiches because it was their lunch break. It was a little bit tight, and it's been so nice to be able to space out and have the whole thing work so much better. So if you make it to our new offices, I think you're really gonna like it. Tonight we have 3 really special presentations ready for you. So I'll stay in here, but if you'll help me with that, that would be great. Well, for Dave. Okay, so the presentation order is Tim Holland. Tim Holland is the outsourced chief investment officer. He helps us with portfolio design, with due diligence on portfolio management. And you guys have heard from Tim before. He does an excellent job. He stays up on what's going on in politics, in the economy. He's going to catch everybody up as to what they should be thinking about right now with regard to markets. So what he's going to talk about influences your portfolios because the research done by his company then gets discussed within the investment committees in their company that then impacts even the minor little adjustments between large companies or small or all the different asset classes within the portfolio. So it's important to hear what Tim has to say. The other 2 presenters, I'm really excited about this because I feel like there aren't enough women in the financial planning space. I actually think women have the ability to listen and hear sometimes better what's going on, and I think that if we can grow women in financial planning space, I think we're going to have more success and a better offering overall. So we've been on the hunt for a long time. However, our priority is hire the absolute best advisors for you, regardless of anything, you know, of course, age, gender, sex, anything, race or anything. It is the most important that you have the very best advisor available to you. I'm just so excited that at the time, we were able to find the best, and they happen to be Laura and Alison. So you're gonna hear from both of them tonight. Alison does a lot of work personally on how to keep track of your own personal finances. She is the most organized person I know. So she's going to be able to show us some of the tools that she uses in order to keep track of finances. So I'm really excited about that. Laura will talk to us about some of the issues and ways to think about with regard to like women in finance. How is that different? I was a little hesitant because I know not everyone here is a woman, but most everyone here has a woman in their life. So for us men, I think it's important for us to hear that and understand it and support the women in our lives and how finances might be a little bit different for them than it is for us men. So that's our agenda tonight. And I'm gonna go through a couple housekeeping items. We have this QR code. I would love it if you would all actually scan it right now because that's how you'll ask questions. So if you scan this QR code and you put in a question, then the rest of you can vote on what question you want answered because usually we don't have time to get to every single question. So if you have something, and you can do it anonymously too, so you don't have to feel like, oh, I'm gonna be exposed. Just put it in anonymously if it's more comfortable, and then look at the other questions and decide what's most important. And we found this to be a really great tool. I'll watch the questions over here and make sure the presenters know what was most interesting to you all and that they take a minute to answer those. Also, in between and before and after, we have 5 gifts. Katie, do you mind tracking down the raffle tickets? I don't know where those are, but I'm gonna do one right now, and then in between each presenter as they get set up, and then one at the end. There's cornhole. My wife loves this Ninja Creamy thing. She makes it with like protein shakes and and our whole fridge is full of these frozen creamy things. She loves those. There's a 23andMe Ancestry kit, a Yeti cooler, and then Tyson, you knew about this one. Is this an air fryer? It is. It's an air fryer. I don't know how to use those very well. All right, so we're gonna get started here, and then if we call your name, then come down and grab it. We don't have to make a huge deal of it. We won't embarrass you. Come down and grab it, and we're just gonna use it to kind of give us a little bit of time to get started in between. Dave Mickelson, come on down. Will you tell Dave? Yes, you won. Yes, come on. You get to pick whatever you want. Yes, you can do it later. Yes, for sure. Yes. You're up, Tim. Appreciate you.
Yeah. I'll take the clicker. Thank you. Okay. All right. Good evening, everyone. We're going to go for about 20 minutes, and we're going to talk about maybe the two most important topics on Wall Street today, the Fed, Federal Reserve, and the election. And as always, appreciate the partnership with Capita and Zach and the entire Capita team, and appreciate your time tonight. So here's what we're going to talk about. So the Fed cut interest rates last month for the first time in 4 years. We've got the election, what it might mean for the markets and the economy, less than a month away. And then we want to give you some thoughts on how to maybe put this somewhat unprecedented political season in perspective. Lots of reasons to make decisions around your portfolios. Asset allocation, typically politics isn't one of them. So the Fed cut rates last month for the first time in 4 years, and folks in our business are wondering if the Fed waited too long, right? So I'll just call your attention to the graph on the left. The Fed took the Fed funds rate to 0 during the pandemic to keep the economy afloat, and then raised rates to 5.5% because inflation was running too hot and the economy was running too hot, right? And the Fed's got a dual mandate, 2 responsibilities, full employment and price stability. So they were focused on full employment. Then they got laser focused on price stability. Now, what's interesting is through the summer, the Fed kept the focus on fighting inflation, even though they already made a lot of progress on the inflation fighting front. So the light blue line on the left is the consumer price index. It's arguably the most followed inflation data point in the world. It just looks at a basket of goods that a typical American would buy month to month. And at one point, the price of that basket in total was up over 9% year on year. That's the spike in the middle of the graph, and then came all the way down to about 2.5% based on the most recent reading of the CPI. So the Fed's long-term inflation target is somewhere around 2%. Now, in speaking of that, I'm not trying to dismiss the fact that prices for a lot of things are still 20 to 25% higher than they were 4 or 5 years ago. And not to speak for the Fed, but the Fed kind of doesn't care about that. They do, but they don't, because their mandate is to focus on year or month-to-month price gains, not the absolute level of price at any particular point in the economic cycle. So the Fed made a lot of progress, but the Fed kept saying, hey, we're going to keep the focus on the inflation battle and not worry about the labor market so much. But the problem with that through the summer was you had any number of data points, at least stuff that folks in our business pay attention to, telling you that the economy was headed towards recession. I would point out 2. Lower right, the Conference Board puts out something known as a leading economic indicator index. It plunged. Whenever it's plunged like that, you've always gotten a recession within 12 to 18 months. And if you look on the left-hand side, the number of job openings went from about 12 million to 9. Now that spike was unsustainable. That was coming out of the pandemic. Employers were looking for workers. Workers didn't want to leave home because they were worried about healthcare or childcare. But over time, those job openings started to disappear. So you had signs that the economy was starting to slow, and maybe slow more than the Fed would want through the summer, right? And then we got the big pivot. So the Fed every year holds an economic symposium up in Jackson Hole, Wyoming. They did it after their July meeting when they did not cut rates. It was held in August, and Jay Powell, the chair of the Fed, said, get ready for a rate cut. And so they cut rates by 0.5 point in September. So that's from 5.25 to 5.5. That was the range on the Fed funds rate, and they just reset it 0.5 point lower. Typically, the Fed only cuts by 0.5 point when the economy is already in recession or clearly headed into one. And Jay Powell made it clear at the press conference that the Fed wasn't that worried about the economy. They were just recognizing the fact that they were probably a little bit behind the curve in lowering interest rates, right? So the Fed wants to set the level of interest rates at a point where it doesn't really spur the economy along and it doesn't hold it back, right? So clearly through the pandemic, at least that's where they are now. Through the pandemic, they took rates to zero because the economy was stuck in neutral because of the policy response to the pandemic. And then once the economy ripped, and unfortunately inflation along with it, the Fed took rates to 5.5% to slow the economy and bring inflation down, right? So after all of that, the Fed was hoping to recalibrate to something that looked more like a normal monetary policy construct, right? So with every other Fed meeting, the Fed puts out something known as the dot plot. The official name for this is the Summary of Economic Projections, and the Fed just tells you where the Fed itself thinks rates are going to go. So the Fed, at least as of September, thinks they're going to cut rates 2 more times this year by a 1/4 point at the last 2 meetings, and then by a full point next year spread across 4 meetings, and then a little bit further until we get to 2027, which will be here before we know it, and the Fed funds rate will be at 2.9%. That's the long-term rate that the Fed thinks will both keep the economy running smoothly without causing inflation, but also not putting the jobs market at risk. Obviously, a lot can change between now and 2027. A lot can change between now and when the Fed meets next month. So what's next for stocks, bonds, and the economy? So ultimately, what folks in our business want to do is get a sense of where the real economy is headed and what that means for risk assets, your portfolios, right? You want to get to where the proverbial puck is headed a little bit early because that's how you create value for your clients. So what's interesting is if you think all the way back to 1980 and the first rate cutting cycle under Paul Volcker, who ran the Fed in the early 80s, actually late 70s, appointed by Jimmy Carter and then reappointed by Ronald Reagan. If you look out 12 months from the first rate cut, typically the market's up about 11%, which is pretty good. And not that unexpected because if there's one thing that Wall Street really likes, it's cheaper money. So as rates come in, that does a couple things. One, it makes stocks look more attractive relative to bonds, but it should also lower corporate borrowing costs, which drives up earnings, and it makes future corporate earnings worth a bit more. So stocks tend to do okay. Bonds tend to do really well. If you look at something known as the Bloomberg Aggregate, which is essentially the S&P 500 for bonds, think that type of index, 12 months on from the first rate cut going back 45 years, bonds have never given you a negative return, which also makes sense because the minute the Fed starts to cut rates, anyone who's going to sell you a new bond, it could be the government, it could be a company, is going to be able to offer a lower yield or coupon on that bond relative to what had just been issued before the rate cut. So every bond that's already trading, in theory, should go up in value. So stocks tend to do pretty well once the Fed starts to cut interest rates. Bonds tend to do particularly well and for good reason. Then there's the economy. This is a little more interesting and a lot more nuanced. Again, if you go back to 1980, 12 months on, about half of the time the economy's in recession, about half of the time the economy's not in recession. And if you go back to how stocks do 12 months on from the first rate cut, the performance of equities ties back meaningfully, which makes sense to how the economy is doing. The economy's in recession, corporate profits probably aren't doing well, stock prices are struggling. If the Fed has skirted a recession, avoided a recession, corporate profits are probably okay, and the markets are probably okay. Through the summer, and we'll talk about this, the focus and the big question was, can the Fed engineer this soft landing? Can they bring the rate of inflation down from 9% to 2%? Can they slow the rate of overall economic growth and do all that without going too far, right? Because monetary policy is a very blunt instrument. The Fed raises rates or cuts rates, and it just takes a long time for that to trickle through the real economy. And usually the Fed goes too far one way or the other. But that's the big question. Can they sort of get back to normal without putting the US economy into recession, right? And so that's the big question. Was the Fed too late? If you go back to the summer, we got a jobs report for July and early August that really spooked the market. And if you're paying attention, stocks sold off about 10% because we entered a period where bad news had been good news, but then bad news became bad news, right? And so the goofy thing about Wall Street, and there are lots of goofy things about Wall Street, is sometimes bad news is bad news, but sometimes bad news is good news. Sometimes good news is good news, but sometimes good news is bad news. I don't know if you need a finance degree to figure that out. You probably just need to read Dr. Seuss a couple of times and you'll catch on. Bad news was good news during the summer because the economy was slowing, which meant the Fed could cut rates in a very credible way. But then when we got a really bad jobs report, bad news became bad news because folks on Wall Street thought, oh my gosh, the Fed really is too late and we're gonna go into a meaningful recession. But then we got some economic data in August and early September that was good, and that good news became good news because it showed that the economy was actually in better shape than people thought. So this is the big question, and we won't know until we know, but I think as we sit here in mid-October, most folks on Wall Street think the Fed is gonna stick that landing. So this gets back to kind of the concern over the summer, hard landing concerns jolt markets, equity sold off around the world, not just here at home. The fear index, the VIX on Wall Street spiked big time. And then if you look at the upper left, and this is a big deal, the lower income consumers really struggling in the US. If you look at credit card delinquencies and auto loan delinquencies, they're higher than they were in 08 and 09. So that rate cut couldn't come soon enough for a huge chunk of the population, right? If you've done well professionally, if you own your own home, if you bought that house 15 or 20 years ago, if you locked in a 3% mortgage, if you have meaningful equity and fixed income exposure, that's a huge offset to the higher prices that we're all paying today relative to 5 years ago. If you don't have that offset, you're in a really tough spot. And the Fed gets that. So they want to try and lower those borrowing costs for the typical American. So there's lots of good news out there. We think the odds are the Fed does pull this off. They skirt a recession. They bring inflation down a little bit more. Corporate earnings are growing year on year. We're starting to get Q3 earnings on Wall Street. So far, so good. And the Atlanta Fed on the right-hand side has a real-time indicator that looks at GDP growth intra-quarter. And the latest reading out of the Atlanta Fed is the economy is growing 3% as we sit here in mid-October. And this is a big deal on the right. I've already talked about this. Consumer net worth is at an all-time high. So if you look at consumer sentiment surveys, if you look at the political environment we're living in, a lot of people are really cranky. And if you think about it from a purely academic exercise, markets that are all-time highs, housing prices that are at all-time highs, the unemployment rate's got a 4 handle on it, 4.1%, and GDP is growing around 2%. Normally, that's a pretty good data set. But again, if you're living with prices that are 25% higher than they were 4 years ago, and you don't have the offset of a meaningful stock portfolio or a house that you own, you're not in a good spot and you're understandably upset. The bond market's behaving itself. When that line spikes on either side of the screen, it means that the bond market thinks we're going into a recession. When it's towards the bottom, the bond market thinks we're going to be okay. And the bond market, even though I'm an equity guy by background, the bond market's bigger than the stock market, and I'd argue much more important. And this is finally a big deal as well. 08, 09 was so tough because of real estate, the housing crisis. The early 2000s were so tough because of the stock market bubble and the horrific events on 9/11. I don't see that structural risk underpinning the economy. And considering the Fed started raising rates 2.5 years ago, if something was going to break in the economy, for lack of a technical term, it should have already shown up. So even if we do get a recession, it should be mild because I just don't see that structural risk in the economy. Okay, so we're going to talk about politics and then we're going to get into religion. All right, just wanted to make sure I still had you. I appreciate it.
Tim, real quick, can I ask you a quick question before you get into politics and religion? There's a question in here. Is the national debt sustainable? And how does the national debt affect my portfolio?
Yeah, so we've been asked that question for years. And up until about 12 months ago, my answer was always, I don't know when the debt's going to be an issue. And if anyone tells you they know when the debt's going to be an issue, they're fibbing because no one really knows. It became much more salient to me when interest rates did what they did with the Fed raising rates and our costs to service our debt were at a level that's greater than what we spend on the Pentagon, right? So if you think about the US government, we've got Social Security, Medicare, Medicaid, you've got the defense budget, which is discretionary in nature, but tends to be pretty sticky. And then you've got a little bit money left over for discretionary spending, and then you have interest expense. And so we're now spending more to service our debt than we are on defense. And so I still don't worry, and maybe this is too Pollyannish to me, all that much about the absolute level of debt, because we're at levels that were unimaginable just 10 years ago, and the markets haven't broken. But what I really worry about is the cost to service the debt. And that crowds out other spending priorities, money that should be going somewhere else. So that's where I think it's become an issue, not so much the level of debt, but what it costs to make those interest payments on a regular basis. So I don't have to tell you, we're in an unprecedented political season. Even before the 2 attempts on Donald Trump's life, even before Joe Biden dropped out, it's only the second time where a sitting president has been challenged by an ex-president, but obviously that dynamic got shifted when Joe Biden walked away. Markets are up a lot. The S&P is up 21% year to date. Markets tend to do better during presidential election years. The thinking, somewhat cynical, is whoever sits in the White House wants the American voter to feel good about the president. And one way to do that is juice the economy by spending more money at the federal level. That juices corporate profits, that juices the markets. So you increase the odds that you get reelected or your party's nominee wins come November. So the pattern we're seeing this year isn't unexpected. Okay, so I live in Pennsylvania. I wish I owned a TV broadcasting outlet in Pennsylvania, because I can't even begin to tell you how many ads I'm getting on terrestrial TV, on my smartphone, on YouTube. It's everywhere. I'm telling you stuff you already know. This race is going to come down to 6 or 7 states. It's an electoral college race. Popular vote will probably go to Kamala Harris because of California and New York. And it's super tight, obviously. These are the states that matter most. What's interesting is, and the data changes every day. If you've never gone to realclearpolitics.com, I'm a big fan of that website. I think it does a good job of balancing opinion pieces and news from sort of both sides of the aisle. And right now, Donald Trump is winning the battleground polls, the average of the battleground polls, instead of by 0.2 points, by about a full point relative to the vice president. So as of now, in the states that matter, Donald Trump seems to have the momentum. So how are people placing their bets? One of the things I love about this country is you can bet on just about anything, including politics. Donald Trump is now winning in the betting markets too. Now there's some volatility there, and this slide's a little dated. He's now up by a couple points. That spread blew out in the vice president's favor right after the one presidential debate. I don't think we're gonna get another. Slowly started to collapse, got to even right after the vice presidential debate, and it's continued to move in Donald Trump's favor. The thinking is, when it comes to pollsters, people aren't always honest. They may not tell the pollster what they really think. If they're putting some of their own money on the line, even if they don't like the person they're betting on that person because they think they're going to win, and there's some predictability there. So right now, the polls at the battleground state level and the betting markets favor Donald Trump. So who's going to win? What's interesting, and I'm not here to tell you who to vote for or who's right or who's better for the country. If you're Kamala Harris, you like what the market's telling you, because the markets are up meaningfully since August 7th. And I'll get to that data point in a second, but when markets rally 90 days out into the election, the incumbent party almost always wins the White House or holds on to the White House. If the misery index is below 7.4, and all the misery index is a combination of inflation and unemployment, that number's now got a 6 handle on it, because unemployment's at 4.1, the consumer price index is at 2.5. If you go back to the last 16 presidential elections, when that number is below 7.4, the incumbent party's won. When it's above, the incumbent party's lost. So if you're Kamala Harris, the misery index is in your favor. Volatility is in your favor. You had a big spike in volatility in late July, early August, when we got that unexpected and unpleasant July jobs report. Whenever the markets sort of have that kind of frightening few days early in the summer, the incumbent party tends to hold on to the White House. When the spike in volatility comes later, the party out of power tends to take the White House, right? So again, if you think about those data points, and here's the stock market data that I got to early, going back to the 1920s, when stocks are up into the election, either by 1 point or 10 points, the incumbent party tends to win. When they're down in the red, the party out of power tends to win. Now, we're going through a cycle that we've never really lived through before. Again, Joe Biden stepping away, a former president going after the White House one more time, and obviously there were horrific events in Butler, Pennsylvania, and then the other attempt on Donald Trump's life in Florida. So none of this may hold. But if you think about it, markets are rallying, inflation and unemployment are low, and the markets are sort of up and to the right, not every day, but most days. So if you're the incumbent, you should feel pretty good. The tricky thing is, and I read a lot of political news like you do too, most Americans do not feel good about the economy, do not feel that the country's going in the right direction, and give Joe Biden terrible marks when it comes to his economic stewardship, and his vice president is running more or less attached at the hip to him. So the data would tell you, you feel pretty good if you're the Democrats. The polling, the sentiment surveys, and the reporting tell you not so much. Okay, so winners and losers from a market perspective.
Tim, real quick, before you go too far, can I
please.
throw a couple questions out? So what was that website? That's one of the questions.
So realclearpolitics.com. I'm a big fan of it. And then it's a whole family of websites: Real Clear Sports, Real Clear Policy, Real Clear Science. It's just, I think it's a very well-run aggregator across different verticals, including the political end of things. And not only is there good reporting and op-ed pieces, but all the polling data we talked about and the betting market data is on there too.
I got a couple more, but I'm going to wait just a minute.
Am I okay on time? Because I don't want to.
Yeah, you're doing good.
Okay. A couple more or no?
Wait till you're done with this slide, and because it'll fit better.
Okay. So ultimately, politics doesn't matter, right? Even though I know I just spent the last 10 minutes talking about politics. It's like, what's this guy up to? Politics doesn't matter, policy matters, right? You have to succeed at politics to have the right to set policy. So I'm not trying to be too cute, but one really doesn't matter, the other one does. One can create volatility around the market and sentiment, how we think about our portfolios, the presidency, and so on, but policy is what matters. So in trying to sort of read the policy tea leaves, this is the high-level thinking as to who wins, who loses, depending on who takes the White House. Now, all this is speculative because to get things done, you need Congress, and we'll talk about that in a second. But at a high level, most folks think if Donald Trump wins the White House, and this is very broad strokes, more domestic-facing companies will do well. Smaller companies will do well because they're more domestic-facing. The energy industry will do well from a lighter regulatory touch. Our industry will probably benefit from a lighter regulatory touch, and trade will probably slow down a little bit, especially around some of the things he's proposed concerning China and tariffs. If Kamala Harris wins, the thinking is multinationals will do better because you might have a more benign trade environment. Green energy, renewables, those should find favor. Healthcare stocks should find favor if they continue to add to the Affordable Care Act. The energy industry may not do so well because you'll probably have a very difficult regulatory construct. And some other niche industries like for-profit prisons would also struggle just from an ideological and a spending and a regulatory point of view. This is big too. The Tax Cut and Jobs Act expires New Year's Eve 2025, which will also be here before we know it. Donald Trump took the corporate rate from 38 to 21. I think he wants to take it to 15, wants to extend all the other tax cuts or where the marginal brackets are now. Kamala Harris obviously has a different point of view when it comes to policy. So we're going to talk about gridlock and divided Congress and why that's usually a good thing. You know, if you have a divided Congress or both ends of Pennsylvania Avenue aren't getting along with each other, this could be an issue for the markets because if the corporate rate reverts back to 38%, that's going to hit after-tax profits. Folks like myself will be thinking what that means for earnings and share prices. But we've got a little ways to go. Okay, one thing no one is talking about is the debt. And my joke was going to be, so I'm not going to talk about it either, but somebody already asked the question, so I already talked about it. But that's okay. So that's it. As a percentage of GDP, hit 135%. It's come in a little bit. There are countries more indebted than us. Japan, Italy come to mind. I think it's the servicing costs more than anything else. You know, I think what would really be good for our country's balance sheet, which some folks may not like, and may not be good for the country in other ways, I think is if you got divided government and you just kind of kept spending steady state for the next 5 or 10 years, You had inflation somewhere between 2 and 3. That gives you nominal GDP, real growth plus inflation of 6 or 7% for 10 years, which would be fantastic. You'll grow your way, not all the way out of this, but in a big, you'll make a ton of progress. So economic growth would cause a lot of this to dissipate over time.
Tim, real quick, I
Yeah.
don't think people understand that we can actually grow our way out of debt.
Yeah.
I think a lot of people think because in our own personal finances,
Yeah.
you don't really have that option. You kind of have to just figure out how to budget better
Yeah.
and spend less.
Yeah.
But in our national economy, we can grow our way out of it.
Yeah.
And I don't know if there's more to share on that, but I think that's important that we all just realize that.
Yeah.
That if inflation is at a small level,
Yeah.
but we keep our spending the same, we
Yeah.
can grow our way out.
Yeah, cash flow just improves at the federal level. That little bit of inflation, which is why, the Fed's got that 2% target, but they're probably okay with a 2.5 or 3 handle. Just inflation of 3% in theory gets you economic growth of 3%. Now, it may just be price and not activity, but to Zach's point, if you can have a little bit of inflation, 2 to 2.5%, and you get real growth of 2.5%, you put it together, GDP is growing 5%, right? GDP is $30 trillion. So that's just another $1.5 trillion per year. You're going to tax a certain amount of that, and that's going to flow to the Treasury. And so if you can keep the spending steady state and ideally below just that rate of nominal growth, which is GDP growth plus inflation, you'll grow your way out of it because your tax receipts will be growing faster than the absolute level of spending. Sorry, go ahead.
I was just going to jump in. You answered this question a little bit, so I think I just want to acknowledge it, and then we'll move forward. But it's how much should I care about the election when it comes to my investments? And you said the actual politics don't matter as much as the policy.
Yeah. So I hate to give you sort of a wait and see answer, but I'd wait and see. I think if we get to November 5th and hopefully we know who won, right? At least a couple days later, and we know the makeup of Congress. I could be too optimistic. I think if you get a setup where it's Kamala Harris in the White House and the Republicans take the Senate, I think Wall Street's going to be more than fine with that. I think if you get Donald Trump in the White House and the Republicans take the Senate, but the Democrats hold on to the House, I think Wall Street's going to be more than fine with that. Because you're probably not going to get big legislative changes. They'll have to do some horse trading around the Tax Cut and Jobs Act, which is going to expire end of next year. But you'll know that you're pretty much going to continue to get what you've been getting. And I think that certainly will create comfort on Wall Street and in the CEO suites of corporate America. I think if either party runs the table, then the policy implications of that vis-a-vis the economy and the markets could be meaningful, right? So if you think Barack Obama, 2008, massive win over John McCain, the Democrats take Congress, you get the Affordable Care Act, Obamacare, right? And Democratic presidents have been trying to get something like that through really since Harry Truman first proposed national health insurance. And then the Democrats kind of get wiped out in the midterms and nothing gets done. If you go to Donald Trump in 2016, Republicans take both ends of Pennsylvania Avenue and you got a massive tax cut. And then the Republicans get wiped out in the midterm and nothing gets done for the next 2 years. Joe Biden, first 2 years, Inflation Reduction Act, American Recovery Act, they lose in the midterms, nothing gets done, right? So it really does come down to both ends of Pennsylvania Avenue. That's what we're going to be paying attention to. And if one party does sort of win outright, we'll have to obviously think about what that means in terms of legislation and the economy. So back to Congress. To get big things done, you need, again, the other end of Pennsylvania Avenue. On the upper left is the split between Dems and the Republicans in the Senate, and then you have the House. I think the most important race in the country outside of the race for the White House is the race for Montana's Senate seat. Jon Tester, Tim Sheehy, he's going for his 3rd term. Jon Tester is a Democrat who's running for re-election in a very red state. Right now, Tim Sheehy's beating him by 6 to 7 points in the polls. Joe Manchin's going to retire. The West Virginia seat's going to go red. If Tim Sheehy can beat Jon Tester, and by all accounts he will, the Republicans take the Senate. So if anyone in here is worried, and I could be wrong about that, but worried about, say, Vice President Harris becoming President Harris, the Republicans taking the Senate is going to be a huge check on what she can and cannot do in terms of cabinet appointments, judges, and broad legislation. So I think that Tester-Sheehy race is fascinating and is worth paying attention to. Okay, so Wall Street likes gridlock. On the left-hand side, if you look at a divided Congress, doesn't matter what party controls the White House, going back a long time, markets tend to give you above average returns. Again, the idea is gridlock is good, which is a term I first heard in '94 when the Republicans took the House with Newt Gingrich, and all of a sudden Bill Clinton had to compromise, and the Republicans had to compromise. But the reason gridlock is good is markets hate uncertainty, and we've talked about this already. And if you've got gridlock, the odds of getting big things done go way down. Now, that may not be good for the country long term. We may need to make this investment or that investment, but if you're running a large pension plan or if you're the CEO of a big company, you know you're not going to get hit with something from a legislative or policy perspective that's going to completely upend the rule book you've been working off. So again, at the risk of being cynical or thinking about it from a capital markets perspective, if you get divided government, I think we will, I think the markets are going to be fine with that. A few other things we're thinking about. For me, the third and the fourth bullet point are really important. This race is going to be super tight. It's going to be decided in 6 or 7 states. Jill Stein, the Green Party candidate, is on the ballot in Pennsylvania and a few other places. If you think back to 2000 and Ralph Nader and those hanging chads in Florida, I think he won 30 or 40,000 votes in Florida, and that was enough to give W the state and the presidency. So third-party candidates in a race this close can have a huge impact as it concerns the Electoral College. And then the other thing is, what if the polls were wrong in hindsight? Right now, Donald Trump's trailing in the national polls by a little bit, leading in the battleground polls. And at least in the last 2 presidential elections, the professional pollsters did a terrible job of adequately capturing his level of support, the breadth and depth of the Trump vote. So if they've done that again, and I'm not saying they're doing it on purpose, it's not professional malpractice, it means that Donald Trump's in even better shape than I think he's in right now. And considering his sort of favorable, unfavorable numbers and just how divided the country is, I think he's actually in really good shape going into the election. So he might even be in better shape if the polls, once again, are just not fully capturing the breadth and depth of his support. Okay, this is my stating the obvious slide. Going back to 1960 through today, markets go up, go down regardless of who sits in the White House. In 1960, Jack Kennedy wins the White House. The S&P was at 50. Here we are with Joe Biden finishing out his one term. We're at 5,800. That's pretty incredible, right? Nothing goes up every day, all day, but pretty impressive. So putting all this in perspective, one of the neat things about working at a big company like Orion is we've got great resources. Dr. Daniel Crosby is our chief behavioral officer. And what that means is he tries to marry psychology and money. Good luck with that, but that's what he does for a living. If you've ever talked to your spouse or your kids about money. And he's got some great insights. And I'm just going to fast forward because I know I'm probably chewing up too much time. So there was a study of 60,000 retail investors. They found when the retail investors' preferred candidate lost the race for the White House, over the next 4 years, they own more ex-US stocks than they would normally. And that's not necessarily a bad thing at any particular point in time, but it's been the bad thing the last 24 years or so because ex-US equities have trailed US equities, right? The flip side of that is when their preferred candidate won the White House, they took more risk and traded less and made almost 3% per year. So typically, you don't want your political tendencies to go anywhere near, or your political beliefs or biases to go anywhere near your portfolio. That said, if I had to take one of those 2 outcomes, I'd take the outcome of take a little more risk and don't trade, right? Take a long-term view of things, work with Zach and his team around your portfolio asset allocation to let time and compounding work their magic. And then finally, and this is one of my favorite slides, the reason I think we should not think about politics as it concerns our portfolio or anything else that could get us to get a little too angst-ridden or emotionally driven when it comes to our portfolios is that tends to lead to market timing. And market timing is never a good idea, at least in my opinion. So we take the S&P 500, we go back 20 years, we put 10 grand into it, we let it ride through the tail end of the early 2000s recession, the Great Recession, and the pandemic. 10 grand becomes 62,000. If you try and time the market, and in this case you got it really, really, you did a really, really poor job of it, and you miss only the 40 best trading days over 20 years, that 10 grand instead of being 62,000 becomes $8,000, right? So this country's got its problems. We've got a very divided political construct right now. At some point it'll get better. The underpinnings of this economic miracle that we all participate in, and I think it's just that, an economic miracle, are not going away, in my humble opinion, which means the economy will expand more than it contracts, profits will go up more than they go down, and stocks will go up more than they fall. And then finally, we've talked about all of this. The one point I would add is that the second bullet point, we're about 2 years into a new bull market, actually a little bit less than 2 years, and bull markets tend to run 3 to 5 years. So it might be kind of hard for us to get our heads around this with the S&P at 5,800, but if history is any guide, we're only 1/3 to 2/3 of the way through this move higher. And if I think about profits, cash on the sidelines, the health of the private sector, we'll get through this election, and I think the markets will be just fine. So I'll stop there. I hope that wasn't too much. I really appreciate your time, and thanks.
Thank you,
Zach.
Tim.
Thanks,
Appreciate you.
Capita.
Okay, there was a question in there. It was a question that we at Capita probably should answer instead of Tim, so I didn't throw it out there. It has to do, and while we're changing things, qualified charitable distributions. It said, are there any news? Is there any news on qualified charitable distributions? So a QCD is the ability to give money from your IRA and have it just disappear from your tax return. Once you reach 70 and a half, you can do that. You just have to give it directly to a charity instead of it hitting your bank and then going to a charity. That's a qualified charitable distribution. Obviously, the person asking the question already knew all that, but for everybody else's sake, if you didn't. They used to make us wait every year to find out if this was an allowed thing. And it felt terrible because every year we'd wait until November or December, and that felt like they would approve it, and then we would rush to do a bunch of them. And then years ago, they made it a permanent thing. The only change that's happened that I'm aware of in the last little while was in 2024, they allowed you to give up to $105,000 instead of $100,000. That doesn't affect that many people because not that many people are giving away $100,000 from their IRA every year to charities. But that's the only change we've seen so far. There hasn't been any legislation to remove it. I wish that you could move it to donor-advised funds, but you can't. That's not an eligible charity for that. But that's the only update. Tyson, will you pull a card really quick? Felt like that was elementary. Can you pull a card? Okay. And then I hope I'm pronouncing it right. Ben Van, is it Otten? Pick what you want, please. Come on down and just grab it. Well done for being here and winning something. But Alison will get going here. Do you need, you got the clicker and everything? Okay, sounds good. The question's going, I think. Will you hit one more?
Yeah.
The QR code, if you need it, I think is in between each set, right? One more for me, if you don't mind. There you go. Yeah, keep the questions coming. It helps me to know how to direct it for you. Go ahead.
Awesome. Can you guys hear me? Everyone good? Cool. Okay, so I'm Alison Frasca. Like Zach said, I'm a wealth advisor here at Capita, CFP, but I'm going to be presenting today on tracking your cash flow net worth. It's going to be difficult to follow Tim's wisdom, but I'll do my best for you guys. Okay, so what I'm going to go over today is I want to talk about, obviously, cash flow net worth, why you would track those things, and then we'll go into a little bit of detail of how you would track those things as well. So starting with why you would track your net worth. The big thing is it gives you a much better understanding of a snapshot of your current financial situation. So some important elements of this, understanding your true asset allocation. So while your investment portfolio might be 70% stock and 30% bonds, if you have a large cash savings, that will impact your overall asset allocation and things like that as well. And also understanding your ratio of how much debt you have compared to the assets that you have. And then once you have a good understanding of your current net worth, that gives you the ability to make more informed decisions about what your next moves are and what goals you want to set for your finances as well. So as far as how to track net worth, there's a really cool tool within Capita's client portal where you can add in other accounts. So by default, your Capita managed accounts will be in there already. If you click on this little add account button at the bottom left, you can link accounts or you can add them in manually. The benefit of linking them is it will update for you as the account balances change. So you can link things like other investment accounts, checking and savings, credit cards, even some mortgages you have the ability to link as well. You'll just click on that add account button and then choose the institution and log in. It takes about a day or two for it to log in that way and populate. But you can also add things in manually, like your mortgage, and you can customize it really easily as well. So adding in interest and growth, payments, contributions, all those kinds of things. That's step one. Once you add all of those things in there, then there should be an overview at the bottom that will show your net worth. So it's going to be all of your assets minus all of your liabilities to show you your overall net worth. And then if you actually click on that net worth, there's a couple of different views where you can get some more details as well. So the first one is going to be this balance sheet view. In the top left, you can choose the drop down to go by specific owner. So if you're a couple, you can choose by spouse or joint ownership, and it will break it down on the balance sheet as well by owner. And then it will also break it down by different categories of assets and liabilities. But yeah, that's a little bit more detail. And then there's also the accounts view. I really like this one because it will show you over time how net worth has changed. Now it obviously only goes back to when the accounts were open at Capita and when you were loaded into the portal, but you'll be able to see if you're on track for the goals that you've set for yourself and how markets have impacted your net worth versus real estate and all those kinds of things. So kind of a cool view that you have there as well. And then moving on to cash flow. So net worth, you're looking at, here's a snapshot of where I am big picture right now. Cash flow is a good way to analyze the day-to-day, month-to-month expenses and if you're on target for different goals that you're setting and getting a better understanding of how you're actually utilizing your money and if you're doing it in a beneficial way for your future. So like I said, understanding your current spending habits. A funny thing that I've found as I've worked with a lot of clients on this is it's very difficult to actually understand how you're spending your money until you see the data. And kind of funny story about this, when I first started dating my husband, I made him sit down and do a budget with me. And we tracked, his spending and stuff, and I can't remember the number, but the amount of money that he was spending monthly on food, he's like, there's no way. And I'm like, I promise you, I'm not making things up.
Hold on, Alison. Wait a second. You said while you were dating, you did this?
Well, it's kind of like a filter of like, would I actually marry you?
Right, but you did this before you got married.
Yeah.
I'm shocked. I mean, that's great, but that's it. That's
well, what
great.
if I did it after and then?
I think it's most people are not as proactive as you. Let's just throw it out there.
Moving on. So anyways, that's just kind of a story of how it gives you a better understanding of how you are spending and using your money. And then it also helps you to plan proactively for the future. So whether that's retirement or having kids, saving for kids' college, those kinds of things, it gives you a better baseline so you can plan for future goals and see where you're at and where you need to be. So with tracking cash flow, there's quite a few different resources that you have available to you. I'm going to highlight just a few here. Now, obviously, the only one associated with Capita is our client portal, but I'm going to highlight some other softwares that we talk about in the office and clients use and things like that. But really, the goal here would be to pick something that fits your preference. So the way that you want to visualize your money, how much time you want to dedicate to tracking it. And obviously, as a Capita client, we're helping you track all of those things as well, but this is just an opportunity for you if you want to be more intentional about your own finances too. So totally up to you. But I'll go through kind of pros and cons of each of these, and then a little how-to for each of them as well. So starting with Capita's client portal, it's hopefully a portal that you're already accessing. So really easy for you to just see these things right there from somewhere you're already going. And then it will track and categorize your transactions for you. So if you link checking, savings, credit cards, it will track all of those for you and sort them into categories. Sometimes you have to do a little work reorganizing the categories, but most of the time it seems like it gets it correct. The cons of this is you don't have the ability to create a budget. So this is really just if you want to observe your current cash flow and how you're spending your money. If you're trying to create a budget or create a goal that you're targeting, this is going to be probably not the tool for you. And then it's not going to create any kind of detailed spending reports like some of the other budgeting software will. And then again, it is kind of a hands-off approach to money management. So it's a great way to observe how you're spending your money, but that's all you're really doing is observing it. And so if you're not categorizing it yourself and tracking it in a spreadsheet, then it's easy to kind of go through the motions and not be intentional about what you're looking at. But great option for saving time and just getting a really quick look at how things are going. As far as how you would do this, so in the client overview in your Capita portal, you should be able to click into a section called transactions, and it'll open up this window. And then you have the ability to filter by different accounts, different spending categories, and the time frame that you want to look at. And then you can monitor your spending with those different graphs that it has up there. So it'll have an income graph and then also an expense graph. And then in addition to that, you have the ability to track patterns on your own in a spreadsheet. So if you use this like in conjunction with Excel, that'd be a great option. And then moving on to Rocket Money. So Rocket Money is a great software that you can use. It also will track and categorize your transactions for you. And it has a couple of other really cool features as well. So it has the ability to find all of the subscriptions that you're currently enrolled in, and you can then decide if you still want to be enrolled in those subscriptions. I don't know about you, but I probably have about 20 that I don't remember that I signed up for, and it just kind of flies under the radar, so that's a really helpful feature. And then it will also generate spending reports for you. So it'll track patterns and give you a little bit more insight other than just this is where money is going each month. And then they do have a free version if you're just looking to do kind of baseline budgeting. The cons of this one, it does cost a little bit more if you want more of the premium features. And it does require a little bit more setup work because you are setting up an initial budget that you're trying to target that it can then compare to on a month-to-month basis. But again, it is a little bit more hands-off than some of the other software that's available because it's tracking and categorizing everything for you. As far as how you would do this, relatively simple. You'll just create an account with them. They have an app and a website, and then you can link all of your accounts, your financial accounts. It'll monitor the transactions for you, and you can just kind of look and observe those as well. And then you can use their spending insights tool to get some more information about how you're spending money, and it even gives you kind of recommendations of how you could optimize your cash flow as well, which is cool. Another very similar one, some of you may have heard of Dave Ramsey. He's pretty big in our industry, but this is his software actually called EveryDollar. This is what I personally use. But it's very similar, but it's a little bit more hands-on. So it's going to track all of your transactions for you. You link your accounts, those kinds of things. But for each transaction, you go in and categorize it into the different categories. So it's definitely a little bit more work. The reason I prefer it is, like Zach said, I'm a little bit annoyingly organized. My husband doesn't love it, but it makes you more intentional when you're paying attention to how you're spending your money, because you have to look at each transaction and organize it. Now, obviously, it's the most time-consuming option, but a more hands-on approach if that's what you're looking for. And then they do also have a free version available, and because it's part of the Dave Ramsey universe, there's a lot more financial resources available to you there, like different classes and those kinds of things that you can utilize. The cons is it does cost a little bit for the premium services if you want more than just the free version. And then it is, like I said, time-consuming because you are manually categorizing all transactions. Very similar to Rocket Money, pretty much the same thing. You're creating an account, setting up your initial monthly budget, and then categorizing those transactions. And then they have very similar like spending insight reports and things like that. And they do actually monitor your progress towards different goals. So you can set a goal for big purchases that are coming up or emergency fund, whatever it is. And they will actually track your net worth as well for you. And then the last one is Excel. So you have a couple of different options here. I personally use Excel in combination with EveryDollar. So I use EveryDollar as kind of the week-to-week, month-to-month. And then in an Excel spreadsheet, I track all of my annual income and expenses, so I can see everything in one spot. on an annual basis. You do also have the ability to either create or download a template and purely use Excel. But the downside of that is you obviously don't have the ability to link any accounts, so you're manually logging any of the data that you want to see. And then it gets a little bit more complicated with reporting, and if you want to see graphs, then it does require some Excel knowledge to create those on your own. But like I said, you can just download. There's tons of free templates for them. You can download those, or you can create your own and really customize it to what you're wanting to track and report. And then you can track your income and your expenses and then make a plan for the surplus. So that's Excel. Just to kind of recap all of this, again, the purpose of tracking net worth and cash flow is to get a better idea of where you're at and where you're going and whether you're on track for that. So that would be kind of the way to be a little bit more intentional about your finances if you wanted to be more involved. And then pivoting to future cash flow, so specifically talking about retirement.
Brought some questions real quick before because this is a good moving away from tracking the history, right?
Yeah.
Okay, so 2 questions. One is, so imagine you don't enjoy this. I know that's hard, probably gonna be hard for you, but most
take
that off somehow.
Yeah.
Everyone else hates this.
Yes.
What do you think are the best solutions for the rest of us that don't love doing this?
So I think if I hated it, what would be really helpful is just doing one of the softwares that's hands-off, it does everything for you, and then tracking on a spreadsheet just purely income and expenses on a month-by-month basis and then if you wanted to track other goals, then you can do that as well. But I think that's kind of like a baseline, a good way to get an understanding of where you are without being time-consuming.
Right, and then if they see a month or some period that has really high expenses, you drill down on just that section rather than drilling down on everything.
Right.
Right?
Yeah.
And there are a lot of people that when we sit down with them to do retirement planning, they really don't know. They don't know how much they're spending. They don't know how much they want to spend. It can make the projections really tough to answer the question around, like, can I retire? It's like, well, what can you live on? Then we can answer that question. Okay, a second question is completely fair. How safe are these sites since they have all your information?
Yeah, that's a great question. A lot of them will have a section where it will tell you what information is being shared, if any, and you often have the ability to toggle that, how much you want to be shared. Now, obviously, I would say if that's a really big concern for you, I'm not going to speak for the safety of the internet because we all know, it can be a little crazy out there, but I would say probably the safest thing, if that's a really big concern for you, is to do Excel, because then it's just privately held. You're not sharing information with any of the softwares or anything like that. But I can speak for myself and everyone that I've talked to that's used these softwares. They haven't had an issue with it in the past. I don't know if you have anything to add to that.
Yeah, I would say the Excel, like you said, Excel is for sure the safest. And downloading, so a lot of people will think Excel and then they'll think, oh, I have to manually enter all of my expenses. I want nothing to do with that. And I'm with you on not wanting nothing to do with it, or wanting nothing to do with that. So the way that I do it every year, I actually download the full transaction report as a CSV file. It's just a simple version of an Excel without formatting or anything like that. Just download that for all credit cards and bank accounts, and then match up, because they come in different columns depending on the bank that you're working with, right? But then just take those and format them in the same column, so you know all of the expenses are in one column. And then at that point, you can just start sorting it really quickly. Depending on your capabilities with Excel, it will take more or less time. But that to me is a really great way for the business to audit how well we kept track of our deductible expenses too. I can go through the cards and the accounts and see oh, we missed something here. I'm gonna get a tax deduction if I can log it. So I think and I don't like this, so I'm the opposite of Al. I really don't like this. I would much rather be on a mountain bike in the mountains. But I do know it's important. So I'll take the approach of download the larger data set, filter and sort it, and then look at trends and see if there's something that needs to be updated. But from a safety standpoint, we use Orion. Orion is the company that Tim works for. We trust them. We use them for our trading. We know their quality control, but we don't know anything in terms of the actual data security going on in these other providers. So I would say, obviously, to Al's point, the internet is wild out there, and be careful, and the safest thing would be downloading your transactions.
And to add to that as well, a lot of the banking apps now will do very similar things to this as well. So they'll show you spending reports, and they'll categorize your expenses and things like that. So that's something that you're probably already utilizing, and they obviously already have your information. So that's a good kind of mix between the two if you're looking to use something like this software, but you don't want to share more information with more places, or you just want something easy that you already are accessing. That's a great option too. Okay, so pivoting really quick to future cash flow, and specifically talking about retirement. This is where I think it really is impactful to have an advisor, because for those of you that have been through that retirement transition, cash flow in retirement is entirely different. There's Social Security analysis. Some of you may have pensions. You have to figure out how much money can I safely take out of my investments on a regular basis without having the concern of running out of money or feeling like I'm not going to be able to afford long-term care. There's just so many different factors. It's a very different stage than being in your working career. And so that's what we're here for, is to help you with all of those decisions and help you figure out, how do I maintain my lifestyle with this huge transition? Retiring is a big transition emotionally, physically, mentally as well. And so we're here to take that burden off of you guys and help you do that whole analysis and run all of the background numbers. We obviously have like statistical models and complex calculations and things that we're running in the background. We're staying up to date on different laws with taxes and Social Security and those kinds of things. So this is something that we're very willing and happy to help you guys with. And we do tailor your cash flow plan to your specific goals and needs. So we want to know what's important to you. If it's more important to travel more in retirement, or pass a lot of money to kids, or whatever it is that's important to you guys, we're going to take all the boring math stuff and make it fit what's most important to you guys in your retirement. So we're here to help with that. Yeah, that's pretty much it. Thank you.
Thanks, Allison. You have the bowl. I have to get. Okay, Susan Hegewald. Did I say that right? Even close, Susan? Yeah, you get to come down and pick whatever you want. Appreciate you being here. So Laura will join us. I don't think we have any other questions in between, so you are good to go.
Okay, we're good. Allison's awesome. My name is Laura Hadley. I'm an advisor here at Capita. We're going to be talking today about women and money. Now, obviously, I am a woman and I work in the financial world. I don't know if that makes me an expert on women and money, but working with a lot of female individuals, being a female advisor in a predominantly male industry, I think that's given me some pretty interesting insight to the challenges that women face in the financial world, as well as the importance of women in the world as well. So I'm hoping you joining us today, if you are a woman, if you have someone in your life who's a woman, this will be helpful to understanding more about those challenges and the importance, and also some steps that can be taken to help empower women on their financial journey. We'll catch up a little bit here. So some of the challenges, statistically, women live almost 6 years longer than men do on average. What does that mean in regards to your finances? Well, we have 6 more years of income that we need to prepare for. So that bar is set a little bit higher for women already in regards to preparing for retirement. Now, there are some limitations as well. Right now, women earn about 83% of what men earn. Not necessarily because they're in the same role getting paid less, but they're not in those same high-paying roles that men are in. And this can be due to lots of different things. One of that being up to 81% of caregivers, formal and informal, are female. So this can be a daughter taking care of her parents or in-laws, or a mom taking care of her kids, taking career breaks, not progressing as much on her career path, or a grandma taking care of her grandbabies. So these caregivers are spending up to 50% more time in this caregiving role than a man. So that's a lot less time to, again, pursue a career or also to become educated in the financial sphere, which is a pretty big challenge. Another challenge is lack of exposure to finance. In general, women talk less about money than men do. If you compare my group chat with my girlfriends to my husband's group chat with his guy friends, they're vastly different. My husband's group chat, they're often talking about investments in real estate or the stock market or how much they're making. My group chat, on the other hand, we're talking about how the family's doing, vacations that we've been on, good deals. The most recent was the best cream for diaper rash. I mean, it's different. And some of that is because women tend to focus on the purpose of money more than the numbers. And I think this can be a great thing, and I see this a lot as I meet with individuals, male and female, and couples, that the man wants to know, are we using index funds? Are we using individual stocks? What type of returns are we gonna get? What tax strategies are we using? Where the woman is also often asking, am I gonna be okay? Am I gonna have money in my 80s and 90s? Am I gonna be able to visit my children in retirement? What happens if we need long-term care? Am I gonna be okay at that point? So the woman is often focused more on the purpose. Now, I think both sides are super important. If we're only focused on the purpose without a plan to get there, it's gonna be difficult to achieve it. But if we're only focused on the numbers, our returns, our accounts growing, without a purpose or an end goal, it's kind of pointless in my opinion. So you need both sides. That's why I think men and women can make a great team working together. Word of advice, if you feel like your wife or your significant other is not wanting to be involved in the finances, try talking through the purpose. What does she value? What does she want to do with these assets? Start there, and then she may be more interested in the numbers and the details of how to get there. Societal norms. Traditionally, men have been the primary player when it comes to finances. I'll tell you a little bit about my own story. If you had asked me in junior high, high school, even early college, if I would see myself as a financial advisor, I would have told you heavens no. For those of you who may know, I actually have a background in nursing, so I never would have chosen finance. When I thought of financial advisors, I just thought of a bunch of bald guys in suits. And then when I got into the industry, this is actually what I found. A lot of bald guys in suits. Some of you may recognize the people on the screen. They are fantastic. They are advisors and managers at Capita. They are wonderful, don't get me wrong. They are awesome financial advisors who are male. But when I go to a conference, the room is full of men and maybe a handful of women. So I get what it's like to be in an industry where males are mostly in that role, in the professional space, but also in the household space. So we talked about some of the challenges, the lack of exposure, the limitations. Because of that, there is a confidence gap between men and women when it comes to investing. Only 28% of women feel confident when it comes to investing, when compared to 40% for men. Now, it's interesting, you may see this and notice this, less than half of men and women are confident when it comes to investing. This is something that I see so often. We meet with people, the majority of them feel underprepared for retirement and feel embarrassed about their lack of knowledge when it comes to financial planning. And because of that, they don't seek help and they kind of just want to ignore it. You've probably heard people say, I'm just gonna work till I'm dead, I'm just gonna work till I'm 90, I don't wanna face the reality of it. But I think that's the biggest hurdle for men and women into taking action and taking the next step. So we have to overcome this shame of seeking help. Know that you're not alone. Most people feel that way. And taking steps, most of the time we meet with people who are in this, space of feeling like they don't want to face it, they're just going to work till they're dead. They feel better because, one, they have a financial plan, they're going to be that much better off, but then two, the peace of mind that they're working towards something, and usually it doesn't look as bad as they're expecting. So those are some of the challenges. Now, what is the importance of women in finance? This number is astounding. So an estimated $30 trillion is expected to transfer into the hands of women in the next 3 to 5 years. $30 trillion. So that's a little bit more than our average annual GDP in the US. That's a lot of money. Does anyone know why this money is transferring to women? Dying. Yeah, I heard that husband's dying. We talked about the longevity. Women are living longer, and a lot of times they're marrying men that are older than them. So their husbands are passing. These assets are now coming to them along with the responsibility of it. This slide is a little bit disheartening to me. So 70% of women who lose a spouse end up switching advisors after their spouse passes. Now, this tells me that the woman was not involved in the financial plan. She didn't have a relationship with the advisor. The advisor maybe wasn't talking to her, talking about her values. And so not only is this spouse, this widow, dealing with the loss of her husband, but she's also dealing with the stress of trying to find a new financial advisor and build a plan. So I think it's so important as a woman that you're involving yourself in your plan so that when something happens to your spouse, you can call your advisor and say, hey, this is what happened, and you can hear on the other side, I'm so sorry for your loss. You take all the time you need, we have it handled, we already have a plan in place. Okay, a little bit lighter of a note here. Women tend to be better investors than men, which is kind of interesting. A recent Fidelity study showed that women tend to outperform men by about 0.4% each year. Not a huge difference, but just to give you a little idea, if we invested $1 million and a woman earned 7.4% and a man earned 7%, over 25 years, the woman's gonna have about $500,000 more than the man. Kind of fascinating. So why is that? Well, men tend to be overactive in the accounts and also a little bit overconfident. So overactive meaning trading probably more than they should. Maybe they should just sit tight and ride the ups and downs. Women tend to be a little bit more patient through the ups and downs of the markets. And overconfidence, maybe feeling like they know something that not everybody else knows, or they're following a hunch. So due to that, that's what causes those worse returns. However, before we get overconfident and a little cocky women, we also do the same thing. We overtrade a little too much, which hurts our returns. So both of us can learn, maybe sit tight and ride the ups and downs a little bit more, but we're not as bad as the guys. Okay, women are huge economic drivers. So as most of you know, the stock market really is the economy, right? We're in the economy, there are companies, Amazon, Google, Costco, Target, and so if the economy's doing well, typically the stock market's doing well. Women are huge drivers of that. So 70 to 80% of purchasing decisions are made by women. Up to 91% of new home purchases are made by women. And I think this one's kind of funny. Half of products that are marketed to men are purchased by men. Only half. So women are doing the other purchasing. A lot of sites will call women the chief purchasing officer of the household. And a lot of times the woman actually knows more, like Alison was talking through, the budget. They know what their household needs to live off of. So they're a crucial part of the plan because like Zach said, we kind of need to know what you're living off of, what you're spending to build this plan for you. So it's crucial that the women are involved because more times than not, they can tell you what the household is spending more often than the men. Okay, so we talked through the challenges, we talked through the importance of women. So what are things that we can do to empower women to take control of their financial future? Education. Education is so empowering. And I will be the first to tell you, it's hard in our industry to find really good financial information that's not designed to scare you or to drive you into buying something. 5 years ago, our company actually started a podcast, and I think it has really good basic general education that's as non-biased as possible. So in the podcast, it's called The Financial Call. There are about 8 different seasons of financial topics ranging from income planning to Social Security to taxes to insurance to charitable giving. And each season has 5 to 6 episodes that starts at the very basic and then builds from there. So no matter where you're at with your financial knowledge, you can jump in and start to educate yourself, start to empower yourself. We also have an education center on our podcast. You can search by topic, find some easy to read articles that can be helpful, as well as these boot camps, which you guys are here today. Quarterly market updates, we send these out. Tim Holland, who joined us earlier, he's often on those, can really help decipher what's going on in the world, how that relates to you and your accounts. Zach, so our president here at Capita, recently wrote a book called The 7 Prosperity Projects. It guides you in order of steps you need to take to reach prosperity in your finances. So you can find that on Amazon, which is kind of fun. And then knowing your own accounts. So I think this is so important. Sometimes one person in the relationship, in Alison's relationship, it's Alison. She knows all the logins and the Excel sheets and where everything's at. But it's so important for you to know what accounts you have, where are they, how do you log into them? I mean, everything that you would need to know in case something happened to your spouse. Another important step is building a support network. Have people that you can talk to, that you can ask questions, engage in conversation. This could be friends, this could be family members. Sometimes you don't feel comfortable talking to either of those. Capita has even done support groups for some of our women in the industry who want to learn more, maybe without their husband there, and be able to have a group of women that they can talk to. So if that's something that you're interested in, reach out and we can tell you more about it. Engaging in open conversation. So that support network a lot of times starts with opening up, opening your mouth, talking to friends, bringing up things, asking questions. Hey, what are you guys doing to save for your kids' college? Or what do you know about Roth? Or, an HSA. Tell your friends, did you know that HSA account is super powerful? It actually grows tax-free. So you can save and you can invest inside of the HSA, not spend from it. And then in retirement, you can take reimbursements, spend it on whatever you want, but in the meantime, it's grown tax-free. So as you have these, experiences, talk to your friends, open up. Let's start talking about money more. And then I know I'm a little bit biased, but I think it's so important to have an advisor that you trust. If you do have an advisor and you feel like you're not involved in the conversation as much, ask questions. No question is too basic or dumb. Ask those questions. If you are asking questions and they're still not talking to you or engaging you, you may need to find a different financial advisor, because we want to make sure that your purpose is heard, that you're answering questions, that somebody is in your corner looking out for you and ready to educate you. So I want to finish with this quote. Linda Taylor, she's a CEO from a financial firm. She said, give a woman $1 and she can put it to good use, but teach her about how money really works and she can change the world. Thank you.
Thanks, Laura. Okay, we have hors d'oeuvres outside. We're wrapping up here, but we have 2 more, right? Well, I think Dave hasn't picked up one because he was first, but wanted to grab it later. So, Dave, do you know which one you want? I sent you a text, by the way. Can you tell him to look at his phone? Look at your phone. Okay. Pam Wilcox. Where's Pam? Is Pam here? There she is. Yeah, you won. You're next. And then we have one more, Charlene Halligan. Thank you guys. While they're figuring that out, thank you guys for coming. We really do appreciate it. I'm impressed at how much you're willing, and a lot of you are regulars to our boot camps. I'm impressed at how much you're willing to learn and the time you dedicate to this. But even more than that, we're grateful that you trust us. It's a really big deal. And as we walk our parents through this process, it becomes really real for us too. As we think about it, it's a big deal that you trust us. We appreciate you. And we would love to host you at our new place. That book, by the way, any clients, if you want, we have 100 copies, and I'll buy more at the cheap rate. So for you guys here, you don't have to go buy it on Amazon. It's like $15 there. We'll just give you a free copy at the office if you want, and save you some money on that. And then, of course, we're going to stick around. Hors d'oeuvres out there. Let us know if you have questions. Thank you again for coming.